In the last days before Lehman Brothers closed its books on the second quarter of 2008, a team inside the firm executed a series of transactions with one narrow purpose. The trades ran through Lehman Brothers International Europe, the London subsidiary. They had to. The transactions required a legal opinion that they constituted a true sale of assets, and no United States law firm would sign one. An English firm did. In an internal email preserved in the bankruptcy examiner's record, a senior member of the firm's finance function called the mechanism basically window dressing. Over that reporting period, roughly $50 billion in assets moved off Lehman's balance sheet. Days later, they moved back on. This episode answers one question: how was a routine, decades-old financing instrument used lawfully by every major dealer configured so that assets Lehman still economically owned vanished from its published leverage figures on exactly the days those figures were measured? The instrument at the center of this case is the repurchase agreement. The market calls it a repo. It is one of the oldest and most heavily used financing tools on Wall Street. Understanding it matters because the fraud invented nothing. It exploited the accounting treatment of an ordinary instrument. A repurchase agreement is, in economic substance, a secured loan. A firm holds securities and needs short-term cash. It sells those securities to a counterparty and at the same time agrees to buy them back at a fixed price on a fixed date, usually within days. The gap between the sale price and the repurchase price is the interest on the loan. The securities are the collateral. When the term ends, the borrower repurchases the securities and the lender collects its interest. Ownership has not genuinely changed. The firm parted with the securities temporarily and took on an obligation to reacquire them. The record shows that Lehman, like every large broker-dealer, financed enormous portions of its inventory this way every single day. The governing standard was SFS 140. The treatment turns on one question: has the firm surrendered control of the transferred assets? Account for the transaction as a financing, and the assets stay on the balance sheet. The cash received is recorded as a liability, a borrowing. The leverage is visible. Everyone can see the firm has borrowed against its inventory. This is the normal treatment. It is the honest treatment. The vast majority of repo transactions across the market are recorded exactly this way, but SFAS 140 contained a provision. Under specific conditions, a repo could be accounted for as a true sale rather than a financing. The critical condition concerned the amount of collateral posted relative to the cash received. In a standard repo, a firm posts collateral worth slightly more than the cash it borrows. Post $100 of securities for every $100 of cash. That small excess is the haircut, and it protects the lender. Under SFAS 140, if the collateral posted was sufficiently in excess of the cash, if the firm over-collateralized beyond a certain threshold, the standard permitted true sale treatment. The assets came off the balance sheet entirely. The obligation to repurchase them never appeared as a borrowing. The threshold, the examiner's report established, was 5%. Post-collateral worth, at least 105% of the cash received, obtain a legal opinion confirming a true sale, and the transaction could be recorded as a sale rather than a financing under SFAS 140. That 5% over-collateralization is where the name comes from. Lehman called these transactions Repo 105. When they over-collateralized fixed income assets at 8%, they called them Repo 108. Consider what this means structurally. A firm borrowing $100 in an ordinary repo posts $100 of collateral and records a $100 liability. Its balance sheet grows, its leverage is visible. A firm borrowing the same $100 but posting $105 of collateral with the true sale opinion records no liability at all. The assets leave the balance sheet. The $100 of cash arrives. And here is the mechanism that made the whole scheme work. Lehman used that incoming cash to pay down other liabilities. So a Repo 105 transaction did two things at once. It removed the transferred assets from the asset side, and it used the cash proceeds to shrink the liability side. Both sides contracted. Leverage fell. In economic reality, the transaction was a loan. Lehman had committed to repurchase those securities within days, and it did. It bore the market risk the entire time. It paid a financing cost for the privilege. The examiner's report was explicit. The Repo 105 transactions were, in substance, financings. Only two things separated them from ordinary repos: the extra 3% of collateral and the accounting election that extra collateral permitted. Lehman paid a premium in the form of excess collateral to purchase a specific accounting outcome. That is the mechanism. The firm rented the ability to make assets disappear. The rent was the haircut, now the architecture. To see how $50 billion moved, we walk through the structure the examiner reconstructed from Lehman's own records. Step 1 is the legal opinion. SFS 140 required a true sale opinion for the sale accounting to hold. The examiner established a fact central to everything that follows. Lehman could not obtain a true sale opinion under United States law. American law firms would not opine that these transactions were true sales, because under US legal analysis, they were not. They were financings. So Lehman ran the Repo 105 transactions not through its US entity, but through Lehman Brothers International Europe, the London subsidiary. Under English law, an English firm, Linklaters, would provide the true sale opinion. The examiner found that Lehman's US operations effectively transferred securities to the London entity, so the transactions could execute under a legal regime that supported the accounting the firm wanted. Step 2 is the counterparties and mechanics. LBIE entered into the Repo 105 agreements, transferring securities and receiving cash, posting the extra collateral that qualified the transactions for sale treatment. Booked as a sale, the securities came off the consolidated balance sheet. LBIE then took the cash proceeds and paid down short-term liabilities. Days later, at the start of the next quarter, LBIE borrowed again to fund the repurchase, bought the securities back, and the assets returned. The entire cycle was timed to straddle the reporting date. Step 3 is the timing. Here, the intent embedded in the structure becomes visible. The examiner found that Lehman's use of Repo 105 spiked predictably at quarter end. The transactions clustered in the final days before the reporting date and unwound in the first days of the new quarter. That is the signature of the mechanism. Had Repo 105 been an ordinary financing tool for managing funding needs, its usage would have stayed roughly constant across the quarter. Instead, the examiner's data showed a sawtooth, usage climbing sharply toward each reporting date, then collapsing right after. At the end of the first quarter of 2008, Lehman moved roughly $50 billion off its balance sheet through Repo 105. At the end of the second quarter, again roughly $50 billion. These were not funding transactions, they were reporting date transactions. Step 4 is what the numbers were used to say. Lehman, like the other investment banks, reported a net leverage ratio, a headline figure analysts and investors watched closely as a measure of risk. In 2008, as the mortgage market deteriorated and confidence in the investment banks eroded, leverage became the single most scrutinized number in the sector. The Examiner found that by moving $50 billion off the balance sheet at quarter end, Lehman reported a materially lower net leverage ratio than its actual position supported. The Examiner calculated the difference. Reporting the $50 billion would have raised net leverage by roughly 1.7 to 1.9 turns. In a market fixated on leverage, the Examiner assessed that difference as material. Step 5 is disclosure. Here the architecture shows its final feature. Lehman did not disclose its use of Repo 105 anywhere in its financial statements. It did not tell its board of directors, it did not tell its investors, it did not disclose the accounting policy that enabled it. The Examiner found no reference to Repo 105 in Lehman's public filings. The $50 billion did not simply move off the balance sheet. The mechanism by which it moved was itself invisible to the readers of the financial statements. An investor examining Lehman's leverage at quarter end had no way to know that part of the improvement was the temporary product of transactions that would reverse days later. The internal record makes the purpose explicit. Emails among senior finance personnel described the transactions in terms of managing the balance sheet for reporting purposes. One senior officer, per the Examiner's report, called Repo 105 an accounting gimmick. The controller's phrase from the cold open, basically window dressing, was not an outsider's criticism. It was an internal description of the tool's function, written by a person operating it. The record establishes that people inside the firm understood what the mechanism did and why. It reduced reported leverage on the reporting date. And it did so without changing the firm's real economic position at all. That is the architecture. A financing transaction dressed as a sale, executed offshore to obtain a legal opinion unavailable at home, time to straddle the reporting date, funding the paydown of liabilities, so both sides contracted and disclosed nowhere. Now the question every fraud of this kind raises: where were the gatekeepers? The detection failure in the Lehman case is instructive precisely because, in a narrow technical sense, no accounting standard as written may have been violated. This is the uncomfortable structural feature of Repo 105. FASB 140 did permit sale treatment for overcollateralized repos supported by a true sale opinion. Lehman obtained the opinion. Lehman posted the collateral. The Examiner's central findings concerned not the mechanical application of the standard, but the absence of disclosure and whether the balance sheet, taken as a whole, was materially misleading. The verification chain did not fail because a rule was broken in secret. It failed because a rule permitted a transaction whose economic substance and reported form diverged, and because the parties responsible for policing that divergence either accepted it or never looked. Consider the auditor. Lehman's independent auditor was Ernst & Young. The Examiner established that the auditor was aware of Lehman's use of Repo 105. This was not concealed from the audit firm. The Examiner also found that in the spring of 2008, a Lehman senior vice president, Matthew Lee, raised concerns internally about the firm's accounting, including matters touching the balance sheet. When the auditor was made aware of these concerns, the response did not produce disclosure of Repo 105 or a reassessment of its treatment before the firm collapsed. The New York Attorney General later brought a civil action against the audit firm over its role. That matter settled, with the firm agreeing to a payment and no admission. The structural point is this: the auditor's knowledge of the practice did not, by itself, produce disclosure. A gatekeeper aware of a practice is not the same as a gatekeeper who challenges it. Consider the legal opinion. The true sale opinion from Linklaters addressed one question under English law: whether the transactions transferred good title such that they constituted true sales for legal purposes. It did not opine on whether the transactions should be disclosed, whether the resulting financial statements were misleading, or whether the accounting reflected economic substance. A legal opinion is a narrow instrument. It answers the question it is asked. The examiner's report is careful here. The opinion addressed a legal question, not the presentation of the consolidated financial statements. The failure was not that the opinion was wrong on its own terms. The failure was that a narrow legal conclusion propped up a broad accounting outcome the opinion never touched. Consider the accounting standard itself. This is the deepest layer of the detection failure. FASB 140 drew a bright line at overcollateralization, post enough excess collateral, and sale treatment was permitted. A bright line rule is easy to apply and easy to verify. It is also easy to engineer around. The line invited firms to structure transactions to land on the favorable side. Lehman did not evade the standard. It complied with the standard's letter while defeating its purpose. The purpose was to separate transactions where a firm had genuinely surrendered control of assets from transactions where it had merely borrowed against them. Lehman had not surrendered control. It committed to repurchase the assets within days, and it did. But because it posted 3 extra points of collateral, the standard treated the transaction as a sale. The standard measured the wrong thing. It measured collateral coverage when it should have measured economic substance. Consider the regulators and the analysts. In the first half of 2008, the market fixated on the investment bank's leverage and liquidity. Analysts built models around net leverage. Regulators monitored capital. And yet the mechanism that adjusted the reported leverage figure at each reporting date was invisible to all of them, because it was disclosed nowhere. An analyst cannot challenge a practice he cannot see. A regulator cannot examine a transaction that appears in no filing. The examiner found that Lehman's board was not informed of the practice. The chain of oversight, from management to board to auditor to regulator to investor, had at each link either no knowledge or knowledge without challenge. What would earlier detection have required? 3 things structurally. First, the accounting standard would have had to test economic substance rather than a collateral threshold, so that a transaction with a firm commitment to repurchase could not qualify as a sale regardless of over-collateralization. Second, the disclosure regime would have had to require firms to report material quarter-end reductions in leverage achieved through financing transactions, so the sawtooth showed on the face of the filings. Third, the gatekeeper aware of the practice, the auditor, would have had to treat awareness as a trigger for challenge rather than a matter within management's discretion. None of the 3 held. The result was a practice operating in plain view of the parties closest to it and invisible to everyone else. The unravelling did not begin with a whistleblower who exposed Repo 105 to the world. It began with the firm's collapse. The mechanism was discovered afterward in the wreckage. On September 15, 2008, Lehman Brothers Holdings filed for bankruptcy protection under Chapter 11. It was, at the time, the largest bankruptcy filing in United States history, the parent company listing assets in the hundreds of billions. The immediate cause was not Repo 105, it was a classic run on a financial institution. As confidence eroded, the firm's short-term funding evaporated. Counterparties demanded more collateral, and the firm could not meet its obligations. Repo 105 had never solved Lehman's actual problem. It had only concealed the scale of the leverage that made the firm vulnerable to exactly that kind of run. When the run came, the assets shuttled off the balance sheet at each quarter end were fully on the books, financed and unsalvageable. The bankruptcy court appointed an examiner, Anton Valukas, to investigate the causes of the collapse and identify potential claims. The mandate was broad. The investigation that followed was one of the most exhaustive forensic reviews of a financial institution ever conducted. The examiner and his team reviewed millions of documents and conducted extensive interviews. The report, released in March 2010, ran to more than 2,000 pages across multiple volumes. It was in this report that Repo 105 was disclosed to the public for the first time. The mechanism invisible in every filing Lehman ever made became visible only when the firm's own records were opened by a court-appointed investigator with subpoena power. The examiner's findings on Repo 105 were specific. The report found that Lehman had used Repo 105 to temporarily remove roughly $50 billion of assets from its balance sheet at the end of the first and second quarters of 2008. It found the purpose was to reduce reported net leverage. It found the practice was not disclosed. It found the firm had been unable to obtain a US true sale opinion and had used its London entity to obtain an English one. And the examiner concluded there was sufficient evidence to support the existence of colorable claims against certain officers and against the firm's auditor over the failure to disclose the practice. Colorable is a legal term of art. It means a claim with sufficient basis to survive and proceed, not a finding of liability. The examiner was identifying claims a party could reasonably bring, not rendering a verdict. The enforcement path that followed matters, stated precisely, because it reveals the structural difficulty at the heart of the case. The Securities and Exchange Commission investigated Lehman's use of Repo 105 following the examiner's report. The investigation did not produce a fraud enforcement action against the firm's executives over Repo 105. The reasons, per public reporting on the Commission's deliberations, went to the same structural problem the detection analysis identified. The transactions arguably complied with the accounting standard as written. The true sale opinion existed, and establishing that the non-disclosure was material and fraudulent to the standard required in a securities fraud case proved difficult. The New York Attorney General pursued a civil fraud action against the auditor under the Martin Act, the state's broad securities statute, which does not require proof of intent to the same degree as federal fraud provisions. That action settled. The audit firm agreed to a payment reported at $10 million with no admission of wrongdoing. Consider what this sequence establishes. A firm moved $50 billion off its balance sheet at reporting dates, using a mechanism it disclosed to no one, obtained through a foreign legal opinion it could not get at home, described internally as window dressing and an accounting gimmick. The primary enforcement consequence was a settlement with the auditor for a sum that was a rounding error against the scale of the transactions. The mechanism collapsed not because it was prosecuted, but because the firm operating it collapsed. Repo 105 was exposed by autopsy, not by policing. This is the structural lesson, and it is not a comfortable one. A fraud that operates by exploiting the letter of a rule while defeating its purpose is extraordinarily difficult to prosecute as a fraud, precisely because the perpetrator can point to the rule. The gap between economic substance and reported form was created not by breaking the standard, but by using it. When the standard permits the divergence, the party that exploits the permission has a defense, the party who forges a document does not. Now, the findings. Repo 105 establishes several structural propositions about financial reporting. They are worth stating without moralizing, because the mechanism is instructive in itself. First, a financing transaction and a sale transaction can be economically identical and differ only in a single engineered parameter. The 3 additional percentage points of collateral that separated a Repo 105 from an ordinary repo carried no economic significance to Lehman's actual position. Their only function was to cross an accounting threshold. When the difference between 2 accounting outcomes rests on a parameter with no economic meaning, that parameter will be optimized. The bright line does not prevent the behavior. It defines the behavior. Second, jurisdiction is itself an instrument. When a transaction cannot obtain the legal support it requires under one legal regime, and the same transaction can obtain that support under another, the choice of jurisdiction becomes a component of the structure. Lehman's routing of Repo 105 through its London entity was not incidental, it was necessary. The transaction could not exist in the form Lehman needed without the English legal opinion. The geography of the transaction was load-bearing. Third, disclosure and treatment are separable failures. Even granting that the accounting treatment complied with SFAS 140, the absence of any disclosure meant readers of the financial statements could not assess the practice. A leverage figure that improves at every reporting date and deteriorates immediately after is a different figure than one that is stable. The non-disclosure denied investors the information needed to tell them apart. The regulatory response addressed the standard directly. In the wake of the examiner's report, the accounting standard setters revisited the treatment of repurchase agreements. The Financial Accounting Standards Board issued guidance that eliminated the assessment of whether a transferor had the ability to repurchase collateral as a determinant of sale accounting, effectively closing the path by which over-collateralized repos could be treated as sales. The Securities and Exchange Commission moved to require enhanced disclosure of repurchase agreements and short-term borrowings, forcing firms to reveal the difference between period-end balances and average balances during the period. That requirement targets the sawtooth directly. A firm whose period-end leverage differs sharply from its average leverage must now show the difference. The gap between what appears on the reporting date and what exists in the days around it is the specific thing the new disclosure regime is designed to illuminate. The Lehman case closes then, not with a verdict on the people who ran the firm, but with a set of amended rules. The instrument was never illegal. The collateral was really posted. The opinion was really obtained. What the case documents is a structural truth about accounting standards that draw bright lines around economic substance. The line will be found. It will be crossed by exactly the margin required, and the crossing will be defensible until the standard itself is changed. Repo 105 was not a lie told against the rules. It was a shape built precisely to fit them. That the firm fitting itself into that shape held roughly $50 billion there, out of view, at the moment its position was measured, and that the shape was disclosed to no one, is what the examiner's record establishes. The mechanism is the finding. There is nothing further to add.